of 2008, and before then, of course, there was a lead up to it. The S&P 500 bottomed at something like 650, 660, something like that. It was oversold then. Is it overbought now at 2,000? Looking at my screen, 2,000.18 is the level. On the telephone now via Skype is Lee Adler, the former Wall Street man who shunned Wall Street but set up the Wall Street Examiner. He is the founder and editor of that subliminal publication. And Lee, at 2000.20, you've been calling it very well for the last 2 years because I follow you. What do you think? Overbought?
Well, I don't think that bull markets get overbought per se. They eventually run out of liquidity and run out of momentum when, in this case, when the central banks decide they want that to happen. This has been very much a central bank-driven bull market, and the central banks will decide at some point that they've had enough and they'll pull the punch bowl. And at that point, we'll see the market begin to reverse, and I think rather dramatically. But in terms of looking for an overbought reading, bull markets can stay overbought in the conventional sense for years. So I wouldn't use that term exactly.
Lee, it's Nozipho in Johannesburg. If we look at some of the data that is coming out of the US, in particular, if we look at consumer confidence, durable goods data, and the whole bunch, it's certainly suggesting that the economy is on track for a rather good recovery. Given that, do you think that this is sufficient to maintain the bull run for now?
Well, I think that the economy and the markets tend to move in tandem, but it's not a causal relationship directly. The U.S. economy has benefited tremendously from an energy boom, a great leap forward in energy technology and fracking and the extraction of oil and gas out of the ground. And the U.S. has benefited from this more than elsewhere in the world. And as a result, the economy has done fairly well, especially in the upper echelons, the upper income strata. Middle income and below have not done as well. But the markets are going to move with the central banks. We've seen that high correlation since 2009, and not just the Fed, but the Bank of Japan and the ECB are all pumping liquidity into the same worldwide pool where the primary dealers play. And those dealers are the ones that will determine at some point that there is insufficient liquidity to keep this going. But in the meantime, the economy will move along a parallel track, but I think it's important, rather than looking at the economic data, to stay focused on the liquidity flows as they're coming from the central banks.
Lee, it's Mark. You mentioned the punch bowl. Now, if this happens, are we looking at a cost of capital effect here, which could deflate the markets? And corresponding to that, could we also have a corporate earnings decline that would go with that sort of process too, and therefore also reduce the Dow and other markets?
Well, I see the actual quantity of liquidity as more important than the price of capital. And I think there's a conundrum here with all the excess liquidity that the central banks have already created. It's not clear to me that they're going to be successful in raising interest rates at any point without withdrawing liquidity from the system. It's a simple matter of supply and demand. You have an oversupply of liquidity, an oversupply of capital. So at some point, if their aim is to increase interest rates, they're going to have to somehow withdraw liquidity from the system. And it's that withdrawal of liquidity that causes the primary dealers, the market makers, to have to withdraw their bids that are currently driving prices higher. So I focus, and I would continue to focus, more on the quantity of money rather than its cost. And sure, there will be a corollary relationship there, that as the quantity of money begins to level out, we should see an increase in the cost of capital, and valuations should begin to come down.
Lee, we were all worried about tapering, and tapering was the thing. As soon as there was the mention of tapering, when was it, a year ago now, the market came off for about 5 seconds and then has continued to rally over the next year. At what point does the market say, wait a second, I've been used to this for the last 5 or 6 years. In other words, I've been used to free money. The free money is gone. Interest rates go up. Is that going to be the key to the market correction, which you said could be substantial? And I think we'll quote you on that. Is that going to be the catalyst to bring this market down from 2000?
Well, I think we have to stay focused on the fact that there are 3 big players in this game. The Federal Reserve in the United States, the ECB, the European Central Bank, and the Bank of Japan. As I said, they're all pumping into the same liquidity pool. Now, the Fed is beginning to pull in its horns and flatten out its quantitative easing so that it will be injecting very little cash into the system beginning late this year. But you still have the Bank of Japan going gangbusters, pumping into that same liquidity pool. They are still pumping in the equivalent of 60 or 70 or 80 billion US dollars per month. And then the big question is, what is the ECB going to do? Mario Draghi sent out some signals from Jackson Hole that enabled people to begin to speculate, well, maybe the ECB is going to engage in quantitative easing. I don't know exactly how they can carry that out without violating their own rules, but if the ECB should step in and begin to buy securities outright, that would be another cash flow coming into the system that would prop these prices up again. So we've got to keep an eye on the ECB and the Bank of Japan. We already know what the Fed is going to do. They're going to cut back. But their other 2 partners in crime will have to wait and see what they do. But I think with the Fed cutting back, you're going to see a much more of a range-bound market in the U.S. beginning next year with some fairly significant swings in both directions. I do think we'll see minor new highs, though.
Lee, thank you so much for that insight. That is Lee Adler from the Wall Street Examiner.